Good morning, everyone. Good morning. On behalf of the OPIC family, it's my great pleasure to welcome all of you today as we talk about spurring development through microfinance, which we are co-hosting with our friends from Habitat for Humanity. We have been so very fortunate to have Habitat for Humanity as a partner and a client on a program called Microbuild, which, as all of you know, is helping thousands of low-income families around the world to build and maintain decent homes. Microbuild is lending to microfinance institutions, which in turn make housing microfinance loans to individual families for home improvement. It's a great collaboration that we're very thrilled to be a part of, and thank you for being here. I'm pleased to share the podium today with Habitat for Humanity's Executive Vice President. I know I'm going to torture your last name, even though you told me several times. Mike Karskaden? I got it, okay. And Deputy Assistant Secretary for International Development and Debt Policy, Alexia Latortu. Alexia and I actually went to graduate school together, so I have lots of stories on Alexia, which none of them will be shared. But so I also wish to welcome and thank those who have agreed to serve as our panelists today. We really have a great lineup individually. They represent leading organizations and companies with years of collective and successful experience working with microfinance. As you may know, decades before microfinance became widely recognized as an effective tool for supplying small loans to individuals and small businesses, OPIC was using innovative financing for micro-lending in places facing tough development challenges and to people who lack access to traditional credit. But of course, today, microfinance is an established tool for development that has reached about 190 million people worldwide. At a time that the developing world continues to face a host of challenges, we're still focusing on ways microfinance can most effectively and efficiently advance access to finance in the regions and sectors that have the greatest need. And today we look forward to exploring this sector even further. It is my pleasure to now introduce Habitat for Humanity's Executive Vice President, Mike Karskaden, to say a few words. Mike began his career in banking in 1994, joined Habitat for Humanity as a controller, later becoming vice president for finance and chief financial officer. In 2000, he was asked to serve as senior vice president of administration, and since 2003 has been executive vice president for Habitat's international division. Mike, thank you for being here, and over to you.
Thank you, Mimi, for that warm welcome, and to the Overseas Private Investment Corporation for hosting this important event this morning. And thank you to our distinguished panel for what I'm sure will be an informative and lively discussion. Many of you may be familiar with Habitat for Humanity. I thought I might just ask a show of hands if you've maybe been to a Habitat work site or volunteered in some way. Terrific. Well, through the efforts of millions of volunteers just like you in over 70 countries around the world, Habitat has helped more than 3 million people construct, renovate, or preserve their homes since 1976. And while we've made great progress, the challenge ahead is enormous. By 2050, 70% of the world will be living in urban areas. Today, 1 billion people live in slums, and that number is expected to double by 2030. The unfortunate fact is that cities in the developing world are unprepared for this influx of residents, and this is a reality that the world cannot ignore. To help meet this challenge, Habitat recently launched a new strategic plan to create systemic change. Building on the success of our direct engagement with families and communities, this strategy will help change policies and systems to improve access to affordable housing and drive inclusive market-based solutions to serve more low-income families. Rest assured, you'll still have plenty of opportunities to go out and swing a hammer. Habitat will continue to serve individual families, but we've broadened our approach to include a wide range of solutions to the issue of poverty housing. Habitat's 2014 shelter report, and I hope everybody picked up a copy on the way in, is entitled Step by Step Supporting Incremental Housing Through Microfinance, and outlines how housing can be one such solution. Resources to provide new housing in the developing world are limited, and few have access to the formal housing finance sector to build an entire house all at once. With most of the developing world building their homes incrementally, microfinance has an essential role to play in increasing access to safe, affordable shelter. Several of those microfinance programs are outlined in the report because they're actually up and working now. Habitat's Microbuild Fund, which Mimi mentioned and which Patrick will talk more about during the panel, is a $100 million impact capital fund devoted to helping MFIs develop shelter solutions in dozens of countries. The fund is paired with Habitat's effort through its Center for Innovation in Shelter and Finance, which is an advisory arm that helps provide technical assistance to MFIs. And it's fitting in this room, and as Mimi said, to state that OPIC has been really instrumental in developing the fund, and we're really grateful for your support and your partnership in this. And now I know that you're all eager to hear from our panel about how microfinance is addressing not only shelter issues, but broader issues within development. And it's my pleasure to introduce our moderator for this morning's panel, Alexia Latorchu. Did I close it off? I didn't go the other way. Alexia is the Deputy Assistant Secretary for Development Policy and Debt at the United States Treasury Department. Previously, she was Deputy CEO at the Consultative Group to Assist the Poor, CGAP, which is housed at the World Bank and dedicated to advancing financial inclusion to help improve the lives of the poor. And Alexia also brings a wealth of experiences and knowledge from her work in developing countries around the world. So please join me to welcome Alexia.
Thank you so much, Mike, and thank you, Mimi, for the warm welcome. So as Mike was saying, for 15 years, I worked on microfinance or access to finance or financial inclusion. The terms have been evolving. So I had a very deep focus on that sector. Now with U.S. Treasury, I work on a very broad range of development issues, supporting the multilateral development banks and on debt issues. And so the topic of this panel this morning, spurring development through access to finance, really allows my two worlds to collide. And so I'm very happy about that. Thank you to OPIC and Habitat for Humanity. But obviously, it's not just my excitement. If I look at the number of people in this room, and if I look at our distinguished panelists that are interested in this collision, and that's what we'll be exploring today. And if I can be nostalgic just for a few moments, I really think the conversation has come full circle. When I first started working on microfinance, our big battle was to make the case for access to finance being something worthy in its own right, being its own sector within development, and not as a tool or an input for other development purposes. And so if you can imagine the big stop signs, we had these stop signs around no to credit components in large projects, or no to credit components in these integrated rural development projects, no to microfinance plus. I'm a little bit exaggerating the case, but that was a little bit what our stance was. Now, of course, there was an acknowledgement that these other sectors, health, education, housing, were important. But the big message we were trying to convey was don't intermingle two disciplines, because, no pun intended, you will lose your own discipline as a sector. To be fair, I think that we had this dialogue not just from the microfinance community, but if you look, for example, at the Millennium Development Goals and their formulation, investments in very important areas, health, education, nutrition, but very little talk about the financing. How are we going to pay for all this? So I think we had issues on both sides. But if you wait long enough, the trends change. And today we're again talking about how to bring together access to finance with other core development goals. Now, I still strongly defend the notion that deep financial systems are a good thing in its own right. Imagine your own lives without access to finance. But you can't build roofs out of dollar bills. You can't, drink sparkling silver coins. And even if you have insurance, quality health care will not magically appear. And so really, the questions for today are how do we bring together different disciplines to achieve greater development impact? How do we better channel and structure finance to truly spur development? And we have a great panel here to reflect on these questions. The first two panelists are going to provide us with really rich examples of what kind of development access to finance can spur. And we'll focus on two areas that are pretty fundamental human needs, shelter and health. And then our next two panelists will help us think through how to structure the finance for the greatest impact. And so with no further ado, Patrick, I'd like to turn to you first. So Patrick, you're the Senior Director for Housing Finance and Market Development at Habitat for Humanity. First of all, congratulations on the shelter report. I don't have my copy yet, but I hope you've left me one, audience. And, you know, Habitat has a pretty important footprint in 75 countries. You yourself have worked with a retail financial institution, Morego in Rwanda. And I'd love to hear from you, and perhaps using the micro-build example to start us off, how do you actually respond to housing needs and the finance needs at the same time? And also comment on sort of how integrated that can be, or do they need to be complementary things that are side to side or really integrated? The housing, providing the housing and providing the finance for the housing.
Yeah, and that ultimately is, I think, one of the core questions that we continue to pursue. And I think we're really, we're trying to explore sort of the perfect fit, right? And that's going to vary by context, obviously. But, we are trying to find a sort of a place where services that are non-financial, and those we refer to those as housing support services, so that where those can be integrated really into a holistic product in a way that accommodates and enables a household to really be able to build effectively. I think that's really core to what we're trying to figure out. And I think we're still kind of on a learning course to do that.
And so do you have people at Habitat for Humanity that have both those skill sets?
That we've had to do that, absolutely. I think one of the shifts that we've seen just in kind of our own capacity building of staff, both at the national and regional level, has been, just obviously with Habitat's core competency being around construction and architecture, that has tended to be kind of the staff composition. But to really integrate sort of a more diverse set of issues, including financial services and access to markets, we have had to bring on sort of economic development specialists, financial service specialists, and to make those services and products more holistic.
Great. Now, one of the challenges, if you look at funding for housing support services and construction, et cetera, is that you typically need longer-term tenures. And yet the capital available often to microfinance institutions is more short-term or medium-term. How have you managed that at Habitat for Humanity?
Yeah, it's interesting. I think when we talk about housing, there is usually sort of this notion of a need for longer-term finance. And I think I would first counter that assumption with, again, sort of the notion that we're trying to promote here is sort of this incremental housing process. I think to speak a little bit more about that, where sort of a formal housing sector is not functional for various reasons, usually due to some ambiguity around property rights, due to people tending to work in the informal sector and not having documented sort of pay stubs to use. The developer-built, bank-mortgaged dwelling is really rare. It's really sort of only a few wealthy people in the country can do that. So really, this idea of progressive building or incremental housing is really pervasive. There's some statistics that are pretty shocking. 98% of housing in Tanzania is acquired in this methodology, 93% in the Philippines. So I think what we're asking is how can we make that incremental construction process sort of work more effectively and efficiently for people. So in terms of the tenor that is required to do that, we do think about housing microfinance, there's really, again, at the broad level, we refer to it as housing microfinance, but when you get deeper into it, we talk about kind of a home improvement loan. We think of a second category as incremental construction, and then maybe a third category as sort of a micro mortgage, which is generally still not a registered mortgage the way a formal sector one would from a bank. But those tenors can be actually quite short. So a home improvement loan can be 1 to 2 years. Incremental construction can be 2 to 4. And then the micro mortgage, you start to talk about kind of 5 years plus. So that type of capital is capital that microfinance institutions, alternative finance type companies can have access to. And so we've had success building that product into some of these institutions, and they've had success really finding local financing and capital to fuel the growth of that product.
Okay, so it's helpful. You're saying, let's be more precise when we say longer term finance. It's not maybe as long as we're imagining. It's not a 30-year, but it may be longer than what traditionally microfinance institutions have gotten, especially for maybe the micro mortgages. I liked your explanation of the 3 different types of products. And actually, I think part of what MicroBuild offers is longer, slightly longer term social investment capital to retail providers. And so as you were thinking about this fund and how it would really contribute something effective, you had to make a choice around the fund manager. And so if you could help us understand your thought process, what criteria did you look at in hiring your fund manager? Where did you end up, and are you satisfied?
Yeah. Are they here? First of all?
There's no direct flight to the Netherlands, I don't think.
No. That was it was an interesting issue for us to take on as an organization when we started, developing the idea of launching this impact capital fund. I think we're Habitat for Humanity. We're pretty DIY, right? And so we're used to kind of doing things ourselves. And in fact, I think I see our CFO back there who I remember was like, we can do this. But the way I would sum it up is, again, there's really, and I think the investor community sort of recognizes this, there's rarely a housing deal that we don't like, right? I mean, we're really for housing. And I think it showed discipline on our part to bring in that risk management, due diligence, expertise that we have by bringing in and finding a fund manager, and handing those responsibilities over to them. It was still important to really have a social mission fit. So Triple Jump, which is a Netherlands-based fund manager, is doing that for us, and we really scrubbed them pretty hard to ensure that they did have some mission alignment as to what they were doing socially, and they're still partially owned by Oxfam Netherlands, which was helpful to us to sort of see that social anchoring. But just operationally, we found the idea of just decentralization, again, because we are so big geographically, it's been critical to have a fund manager who really kind of matched that footprint, and not only matched it, but works that way. So decisions being made, in Washington or the Netherlands wasn't going to work. We needed sort of somebody with a team that was spread out who could really work with our people locally, and they've done a good job doing that.
I think that's a really important point you make about the footprint in the actual markets that we're trying to work in. And a lot of impact investing conversations, I hear people that are sitting in different capitals say, but I can't find the pipeline, I can't find the deals. And it's like, well, you might need to leave, Anyway, so appreciate that point. Now, the issue is not just capital, right, in all of this. So technical assistance is also part of what makes this work. And you do have a technical assistance program as well. So can you tell us more about that?
Sure. We basically, housing microfinance is still pretty nascent. If you look at the data, somewhere between 2 and 3% of global microfinance portfolios are in housing. That it's actually, in another way of looking at it, there's actually a lot of housing microfinance, because if you do surveys, people are using micro enterprise loans for housing. We've found upwards of 60%. In general, I think the number that's thrown out there is 30, 20, somewhere around 30%, 20 and 30%. I think it depends on the country, but we have found 60% in one of our partners. So, one of the ways we're looking at it is if we can move the market from 2% to 10% of global microfinance portfolios, really that represents $4 billion. I mean, we can move $4 billion into low-income housing, which really is our goal. So the technical assistance is really kind of taking on that market moving. Pushing it out the capital alone is insufficient. So the technical assistance is really does three things. I refer to that first piece as working with local institutions, building their capacity, doing product development and market research to understand what people need. That's kind of the first piece. The second piece is, I refer to it as this housing support service part. And that is to understand the housing environment, the construction issues that people are facing, particularly at the base of the pyramid, and to try to either address those with services or to create linkages to local private sector markets that match those problems. And then the third piece is monitoring, evaluation, and learning, which again, with this being a demonstration fund, one of our goals is to really have learning that impacts the sector. So, we're hoping to, if we imagine 25 or 30 investees, to really get all of their stories, what is working, what is not working, and put those into publications and different types of training efforts so we can advance those in the sector and really sort of push that market forward. That's the TA.
So Patrick, I have one last question for you at this stage. You have used the word incremental a lot.
Mm-hmm.
It's in the title of the new shelter report. And you've, I think, explained why this approach of incremental. Now, there's some people who would argue that what housing microfinance does is actually facilitate, frankly, subpar housing construction. It's a bit of a Band-Aid to a really deep housing challenge, and that the housing that is built through these small amounts of money is maybe not the best housing to be stable in the facing a natural disaster. How would you respond to those views?
Yeah. Well, yeah, and I think we would agree with that to the extent that, we wish there was a way to build create housing opportunities for 1.7 billion people. The reality is with that magnitude, there has to be informal sector mechanisms that are driving this process. There's a mountain of sort of government-led housing developments and projects that are good, but they often, aside from construction quality, have not been in the location that people have needed to be and have had vacancy issues. So we do see incremental housing as kind of the way to complement those other forms of housing with a bottom-up approach. And the other thing I would add that is important too is, a lot of the tweaks to a home or a construction process that need to be made to make it disaster resilient can be really affordable. Actually, Microbuild's first investment is a great story of that. We made a $2 million investment in an institution in Tajikistan called Imon, and they're doing really small home improvement loans, some incremental building loans, but their average is really just over $1,000. I think it's a $1,300 average. But I mean, they do have earthquakes and issues there with just stability of home construction, and so there's a simple technology that is not that well known in the market of just using kind of mulberry branches as a part of the construction process to make the walls more resilient from a tremor. And that's very affordable. And so one of the things that we've been doing as a part of the housing support services with that product, is not requiring it actually, but to really just do social promotion of this affordable way to address that issue. And so, I think a lot of those issues in Africa, for example, we see a problem with often cement mix ratios. And that we've been able to address in just really simple ways. Loan officers, actually. We've been able to train loan officers with some key things on, tips on mixing cement, which is something loan officers can do. And that has made improvements on people's home construction. So I think we acknowledge that it is an issue. But I think there's good ways to address it systemically, and we're trying to find those that are efficient.
Great, thanks. A very sort of thoughtful and approach to this. So thank you. Great. So be ready, because once I talk a little bit to Rick now, you'll have a chance to ask questions of the two panelists. So start getting ready with your questions. So thanks a lot. Patrick, so Rick, you're the president and you're the CEO of Global Partnership, which is a impact investor nonprofit with 20 years track record working in micro enterprises, rural livelihoods, health, and green technologies. We're going to focus more on the health aspect of what you do today. And you've spoken publicly quite a bit about the benefits of taking creative approaches that combine preventive health education, health services with microfinance. And so I'd love to hear from you how this works in practice and what successes have you encountered, but also what challenges in Global Partnerships work.
Sure. And maybe I'll just start with, the 190 people that you mentioned at the outset that have access that are now being served with microfinance. So that's almost 1 billion people if you think about family size. So we're reaching 1 billion people of the almost 7 billion people on the planet with this platform. So what we've been doing for some time is to say, certainly deep financial inclusion is one important aspect of empowering people living in poverty, but we all know that there are other facets of it. If you're poor, you're sick. If you're sick, you're poor. Housing and health are actually integrally related. Clean energy and health are integrally related, because if you don't have any clean energy, or if you're burning kerosene and wood, you're getting sick, or you're burning your house down. So these are integrated issues. And from a strategic point of view, what interests us and has for some years is to say, look, what are the other market-sustained ways we can leverage this platform? This platform is reaching 190 million people. We know it's not going to be a one-size-fits-all approach. There have got to be other ways. So our health work really grew out of that inquiry. So just maybe two examples, just so we're all got something concrete in mind when we talk about health and microfinance. So if you're a member of a village bank, so you're one of, let's say, 16 women that's meeting every 2 weeks at a village bank in a group lending methodology. You're already meeting for an hour. You're already there. And you're probably going to the branch every 4 to 6 months to basically get your disbursement, right? So we look at that and we say, look, what is it that microfinance institutions are uniquely capable of doing to leverage the village bank touch point and the branch touch point? So by way of example, we've got work going on now in Haiti, Ecuador, and Nicaragua, working with partners where to create programs that can be fully market sustained. They're basically the payment mechanism. If you get the cost of delivery down, you can actually, at about 1 point of portfolio yield, pay for the full cost of the program. So it's scalable, therefore, to most or all of the borrowers of the MFI. So in Nicaragua, let me just talk about that one. So we work with our partner there, 53,000 women, who to develop a preventive health education and a smart health consumption education for the women in all those village banks. The women are almost always the decision makers in the home about family health. They are already spending some resources on it. They're usually doing it with poor information. They're usually doing it without access to really qualified providers. So by just bringing them basic information on how to prevent disease, like diarrheal disease and upper respiratory disease in children, through simple techniques. And then we combine screening. So screening in Latin America, for example, one of the biggest issues is risk of chronic disease, and diabetes in particular. And you can screen for risk with body mass index when they go to the branch to make their loan payment anyway. So by basically putting together a package of preventive health information, helping train those moms on how to make more informed decisions on behalf of their families. So when do you actually take your child who's almost always coughing to the doctor to be treated for upper respiratory disease, by way of example, to get them access to very low-cost screening. And the other thing we're seeing is that the MFI can play an important role in negotiating on behalf of all of its members, in this case 53,000 women and their families, for preferred access to a qualified provider network. So essentially they're playing the group purchasing role on behalf of all the members, rather than leaving each member to the vagaries and tender mercies of whatever healthcare system exists in that country. So what we found is that in that example, that by thoughtfully putting together a preventive health curriculum, a smart consumption curriculum, access to screening at both the Village Bank and the branch touch points at very low marginal cost. We also are cross-training, or encouraging them to cross-train credit officers who can deliver a lot of this, and therefore you're leveraging a distribution system that already exists, that you can do this at very low cost. We've, as part of the referral network, for example, Portfolio Yield pays for the education and screening. The service package that we put together with the preferred provider network costs less than $2 a month, which is less than those families are already spending on healthcare. So that's a way of leveraging the Village Bank infrastructure for health. Another example would be, so now again, you're a mom, you're making the healthcare decisions for your family, and you live in a remote area. When your child gets sick, where do you go to get medicines? Right? So typically what you do if you're in a rural area, you don't have obviously a car. You're either walking, or if there's bus, you're lucky and there's a bus. It takes you 3, 4, 5, 6 hours to get to town. The drugs are expensive. And so we're working with a women's cooperative, 33,000 women in Honduras, to create distribution points for 20 to 30 essential drugs, most of them over the counter, some of them very basic generics for upper respiratory, diarrheal disease, those things, in 200 sites in these areas, leveraging their already existing micro entrepreneurs. So you've got women in particular that already have a pooperia, they have a distribution point, they're in a community. So working with a partner to create 200 distribution points for access to low-cost medicine. Then what you do at the household in doing that is you save them all the time of going to the market. You save 25 to 50% of the drug costs. You increase the likelihood that they'll actually treat disease in a timely basis. And by just addressing those access issues, by leveraging the distribution system that's already existing with the micro-entrepreneurs, you're bringing health closer to those poor households. And that is also a market-sustained mechanism, because you can lower the drug cost by about 25 to 50% and still cover the distribution costs by just getting the sites right. Because there is demand out there. An average site, for example, in the pilot we're working in Honduras, is serving 230 families, and you can get enough volume and enough product margin to cover the cost of distribution. So that's what we're about. It's how do we leverage the distribution system, not just the financing capacity, but the distribution system that microfinance and cooperatives represent, and move more opportunity through them.
It's very, very powerful, and I think you make a very eloquent case for leveraging the distribution system. And in some ways, you're really describing to us emerging business models for getting affordable products and services out to the sort of last mile communities. I hope this is not too detailed of a question, but I think in terms of understanding how the numbers do work, you say it's just low marginal cost, you said. Could you provide us almost the anatomy of a particular
Sure.
deal to actually understand how the money works along the different parts of this value chain?
Sure. So let me go. I'll use the Village Health example, just by way of example. So right now the client, the micro borrower, so this particular MFI has somewhat over 50,000 borrowers. So they're affecting 250,000 people. So they're already paying a loan on the interest rate. And so when you actually think through, and this is one of the things we do venture philanthropy combined with having them develop technical assistance to develop a business model, in addition to doing loan financing. So we work with them and to redesign the way health education and screening is delivered to have it be very low marginal cost. So what you can do when you kind of work through all the numbers, if you cross-train a credit officer rather than having a duplicate health staff, and deliver it already at the touch points as opposed to creating new touch points, you can basically cover the full costs of the education and screening for about 1% of the portfolio on the portfolio yield, 1% on the loan, maybe 1.5. Okay, that's if you get it at scale to all 50,000 women in that case. Okay, so education and screening can be covered that way, and it's essentially the incremental cost. And the incremental cost, by the way, it's important to think about that not just from the MFI perspective, which is I've got to cross-train my credit officers, and now they've got to spend a little bit more time than they did before, and I have to have a trained community health worker come in and do basic screening. That's what the costs are to do education and screening. But you also need to think about it from the standpoint of the woman living in poverty, because if you save her all her time, if she's not treating, if she's not having to travel that far, if you're getting her earlier information, if you're already getting the information to the point where she's already spending her time, you're giving a whole bunch of time back to her, and she's able to spend that time then doing whatever it is, on the kid's education, on her micro enterprise, however she's going to choose to spend that time. So that's the education and screening economics. The delivery economics are harder. I mean, this is not a magic pill. I don't believe that microfinance institutions are going to somehow magically become distribution points for huge amounts of health services. It's really about how you more intelligently leverage the distribution network for primary and specialty health services that already exist country by country. So there's not a magic pill hill for MFIs, becoming healthcare providers. But where the leverage is there, again, as I mentioned, is one is in the buying power and the information power of the MFI in terms of figuring out good provider networks and negotiating better rates, and getting preferred access for their clients, and then making it on a prepaid basis available to all their members. What we've learned is that people living in poverty won't pay for risk-shifting health insurance. Right, so if you're a mom, you'll save for things you know are going to affect your family. You will not insure against things that are going to only affect you one time in 20. Not going to happen, right? So that's fine. Let's create a payment mechanism where it allow essentially a prepaid mechanism. And what we're finding is that for 3 primary care visits a year, in addition to the screening that they're getting and access to some basic labs, you can get that to a family in Haiti or Nicaragua for under $2 a month. And those visits can be used by the woman herself. For example, let's say she's pre-diabetic, or they can be transferred to the visits. So by leveraging, creating the network and getting the cost down, and the household still bears the cost. It still bears that $2 a month cost.
No, great, and I really appreciate how level-headed you are in terms of development loves the swings, and you're saying, okay, microfinance institutions are not going to solve all the issues, but there is a role, and we can pinpoint to what that role is. So great. So my last question to you is, we're at OPIC. OPIC obviously thinks a lot about capital and the effective deployment of capital. So I'd like to hear your thoughts about capital alignment. And how do you think about the right type of capital at the right time to the right stage of an enterprise's growth?
Okay. So what we're finding is that that it's useful to think about philanthropic capital as well as working capital, be it loans or equity investments, as a range of tools, and just be clear on which type of capital is doing what job. So from our perspective, philanthropy is best used to catalyze market-sustained solutions. And that's a mindset shift, because we just don't believe there's enough philanthropy to sustain things charitably all over the world at the scale of impact we'd like to have. So that's our view of how you use philanthropy: catalyze market-sustained solutions that can have deep impact. And then let's use loan capital and equity capital when we can sustain and grow things that have already been proven. So philosophically, that's how we approach it. So we bring venture capital to fund the startup costs of solutions that have not yet been developed and proven. And then we have loan funds. So we've done 5 loan funds, 4 of which OPIC has participated in, and we're grateful for that partnership, to basically fund the working capital needs of organizations that have already been proven. The other thing I would observe about capital, and it's a question we often get, is there a trade-off between social returns and financial returns? We have a slightly different view, which is to say the market for capital really isn't working as well as it needs to and can. And if we have a fully transparent capital market where the social impact, most people are familiar with what economists would call negative market externalities, right? Which is you poison the water, the company poisons the water, and a lot of people get cancer. Why did we let that happen, right? But I think there's less discussion about what we call positive market externalities, which are really good things happen when you put capital into something. So I would suggest that $1 into a microfinance institution that just does financial just as vanilla microfinance, is not having as much impact as a dollar into one of the partner that I was describing, where the woman is not only getting microcredit, but is also getting access to preventive health, screening, and services. And we'd like to see a world where the market's more transparent and the pricing of that capital can actually be reflect not just the financial return, but the social impact that dollar's having. So use philanthropy as catalytic. Let's move to a more transparent market where the real social impact can be valued, and that's how we'd like to see capital move.
Great, excellent. Thank you so much,
You bet.
Rick. So now we're going to hand it over for 3 questions to either Patrick or Rick. So please get up. I think there are mics around. Your name and your question briefly. Please. Name and your organization, please.
Hi, I'm Susana Rojas Williams with Habitat for Humanity International. My question is actually for Rick, because I see a lot of opportunities for a good partnership here. And I was wondering if there had been already experience around, education and awareness that had actually mobilized communities to invest on preventive measures, on health around better access to safe water and perhaps improvements on sanitation facilities tied to hygiene education. Because I think that's an area that we're also focusing on in terms of our housing microfinance, and I can see how there can be a lot of opportunities for synergies here.
So we're going to take all the questions and then we'll
Okay.
do a wrap. So yes, we have time for 2 more questions. Please.
Good morning. I'd like to thank the panel for their thoughtful remarks. I'm Jose Biau. I'm with FRB Realty Capital. We structure debt and equity capital for commercial real estate transactions. We're actually looking at sub-Saharan Africa. My question is for Patrick. You mentioned the nature of the demonstration fund. Assuming you're mostly investing in institutions and fund managers. For a company like ours, looking at projects with direct developers. Take an example for Benin, larger low to mid-income housing development. Given the demonstration fund nature of the, would you consider a direct equity position, assuming, let's say, OPIC is offering 65% of the construction debt? Do you have that kind of flexibility, or you're mostly looking directly investing into fund managers? But that's kind of a question I had on a transactional basis. And if not, what are the flexibilities and, moving forward as the fund grows, if that would be a capacity? Because what I've realized is that, direct equity for larger projects in sub-Saharan Africa is very hard to access. But if you're working in conjunction with OPIC, it might be an opportunity.
Great. And is there a 3rd question? 1, 2, 3. No. So over to you, Rick, on Susanna's question around your own.
So we have, just by way of context, we have investments now in 41 partners in 12 countries in Latin America and the Caribbean. I would say that maybe the better part of half of them integrate some type of education. They may not go all the way to the kind of preventive health education, screening, and services that I was describing, but they have an education curriculum where they're leveraging their Village Bank distribution to do it. What we see in most of those is, at a minimum, what you see is financial literacy and business education, which in combination with credit is more effective in at least creating more stable microenterprises and more stable income, kind of more shock-resistant households. The evidence does not suggest that those 2 things kind of move people all the way out of poverty. But in the best examples, what we see is what I would describe as holistic, dynamic, women-centered education. So Crecer in Bolivia would be an example, more than 100,000 borrowers. And it includes components exactly as you're describing. So not just financial literacy and business education, but basic sanitation, nutrition information, basic health information, domestic violence information. And so what we're seeing is that particularly the Village Bank and group lending channel that is serving less educated, lower income, predominantly women, that this type of information is really powerful. What I haven't seen systematically yet is kind of I hate the word replicable because nothing is actually replicable in global development, but a curriculum which could at least be a starting point to be adapted into local markets where some of those best practices exist. It's one of the things that we're seeing emerge out of our portfolio. So.
Great, thanks. Can you take equity positions, direct equity positions?
We actually can. cannot. And just to comment on that too, so microbuild really is, again, we're seeking to advance kind of retail financial services to clients. So that would be sort of in this home improvement loan, incremental construction, or kind of micro mortgage space. Real estate development, we think, is a different product. So we don't think it's appropriate for this fund. It's really not in the wheelhouse of our fund manager to be able to assess those deals. And it's probably not a great solution for us to pursue just with the way that microbuild has been structured. So fortunately, though, microbuild is kind of a play under a larger capital markets goal that we have to really sort of mobilize capital for housing. So we see this as kind of our housing microfinance fund. We're talking about several second fund ideas, and kind of a real estate development fund is something that we would consider for that second fund. But again, it really isn't a great fit right now for microbuild and what we're doing.
Can I comment briefly on that?
I am
sorry.
going to say no.
Oh, okay.
I'm so sorry, but I'm going to
That's all right.
exercise because
Good for you.
I want to make sure. Yeah, you got when you can, you just got to go for it. So no, but I do want to make sure that we get to the how we actually structure some of this finance too. So I do want to move, and then if we have time, we can come back. So apologies. So Isabelle Barres, you're the director of the SMART campaign of the Center for Financial Inclusion at Action, and so you lead the campaign's global efforts to keep clients first. In microfinance by embedding core principles of client protection in all aspects of microfinance operations. And so I'd love to hear from you some of the objectives of these client protection principles, and as importantly, how does that campaign actually make change happen on the ground for clients?
Okay, great, thanks. Maybe first, before answering the question, I want to reflect on something you said earlier. There was the reflection that microfinance has shifted over the years, and this is very relevant to the work that we're doing on consumer protection. And by that, I'm referring to the fact that when this movement started, we started to talk about microcredit, so very focused on one type of product. Here, we've clearly talked about extension of that with the microcredit plus idea, but we went from microcredit to then microfinance, in taking into account the fact that low-income and underserved populations need to have access to not only credit, but also non-credit financial services such as insurance and savings and other types of products. Now what we're seeing, which has already been mentioned also by the panel, is a shift yet again to financial inclusion. And I wanted to pick up a little bit on this because it's relevant to the consumer protection issue. So when we refer to financial inclusion, we refer the focus. I think what it has helped to do was to shift the focus not only to access, but also to add some other critical elements to that. And with that, I mean access with quality. So we're talking about making sure that populations that are having access to the financial services are having access to quality services, and also the notion that there needs to be financial capability so that the clients who access the services are also empowered to make good decisions. So it's with that context that I'm going to talk a little bit about the quality piece, the work of the campaign. The campaign is a global campaign that was launched in microfinance industry in 2009. And the goal of the campaign is really to put the clients back at the heart of microfinance and make sure that products that are offered in a way that doesn't cause harm. And so our work itself has been shaped by the shift from microcredit to microfinance and now to financial inclusion. When the campaign was launched, the framework to talk about client protection was around 6 client protection principles. And in June of 2011, we upgraded the principles, so to speak, to 7 principles. And the main reason for that shift was really to take into account the fact that financial service providers were offering much more than credit, but this wider range of both financial services but also non-financial services such as health and education, and that we needed to make sure that when we were talking about protecting clients that we were coming up with standards and guidelines that also allowed to cover these very important services. Savings is a really good example. Savings is almost even more important to protect than loans in the case of poor clients in in many countries, there are many financial service providers that are offering savings under regulatory, basically without regulatory framework, either legally or illegally in some cases, but that really puts clients at a really high risk. So now to answer your question, sorry for the really long introduction. So getting to the heart of the question, the way in which we make change happen, we feel that the philosophy of the campaign is that the financial service providers have the will and commitment to protect their clients, but what is needed is really to provide some practical know-how on how to move from the principles of client protection to really implementing the principles in practice. So a lot of the work of the campaign has been focused on developing tools and working with local service providers also to help accompany the MFIs that need to improve change. Another important element also is that we feel it's important that there are appropriate rules and incentives also for the financial service providers. And what I mean by that is that there should be penalties for not having good client protection practices, or for not protecting your clients, or having abusive practices, or over-indebting your clients. And by the same token, there should be incentives also for organizations that are investing in good client protection practices and are really putting attention and putting the clients in the center of their operations. So we feel that with all these elements, this is how we can make change happen. And that's what we've been doing for the past 3 years. A lot of our energy has gone into building capacity at the local level. Now we're moving to another stage. That is what we're hoping, is that the campaign will become obsolete. So I hope that I will be out of a job very soon, or that at least it will operate in a different way. We've been working with over 40 partners locally, mostly microfinance associations, but a lot of other organizations. Now we're looking at a partnership with Consumers International also to link with consumer organizations and really find a better way to have a dialogue between the representatives of the providers, which for us has been the microfinance associations in most cases, but also consumer organizations and the regulators, because in many cases regulation around client protection is either weak or non-existent, or in some cases also counterproductive, such as the many countries that have interest rate caps that make it very difficult for organizations to operate.
Excellent. So it's the oath of, I think, all development workers should be to work ourselves out of a job, or at least to reinvent ourselves continuously to push the frontiers. But Isabelle, you obviously heard the discussion that we're just having now, and I'd be interested in your thoughts about whether any new risks are introduced to the system and to clients specifically when we start seeing finance tied to a specific purpose. So, close your ears, dear Patrick, but you get a loan to improve your house. The provider is sort of decided upon, it's shoddily done, the house collapses.
Of course, there are risks, but I wouldn't say that they're new risks. I think that the risks are there regardless of what type of products are introduced to the market, and there are risks if the products don't meet the client needs. And one thing that has been emphasized before is the market research, product development, the need to really make sure that the products that are developed meet the needs. That's one of our core client protection principles, is appropriate product design and delivery. And so I really believe that this may actually highlight that it may actually reduce the risk in the sense that there is more transparency and honesty about how clients are really using the funds. The statistics that you mentioned, Patrick, is 60%. I remember from the report, the shelter report, the number I think was 20% of microenterprise loans, or so-called microenterprise loans, are actually used for housing. Well, if there is more transparency about that from the get-go, and we know that this is the case, then the products can actually be designed from the start in a better way and put clients less of a risk. Because in that particular example, what we may see if a client really takes on a microenterprise loan but really has the intent of using it for housing, Then they may complement that with yet another loan. It's not one loan, it's 5 loans to meet the actual need, and then get into situations of over-indebtedness because one financial service provider doesn't know that they have all these other loans. So it's really, I think, potentially areas of risk, but you don't have to shut your ears so much. I think it's also a lot of opportunity to actually have better protection for clients.
Right, because the starting point is not what the supply side thinks the client needs, but it really is what the client needs are.
Right,
Absolutely,
right.
and client needs are obviously, enterprise development is important, but there's a host of other needs, as has been underscored by the panelists.
Right.
Great, thank you very much, Isabelle. So I would now like to turn to Lauren Rodwin. You're the Managing Director of Micro and SME Finance in the Small and Medium Enterprise Department here at OPIC, so thank you for having us. Now, your team provides debt financing to retail institutions, to intermediaries, to funds, to social enterprises in both the microfinance and the impact investment space. And we've obviously been speaking quite a bit about housing finance, about financing for health, and these are two areas that even in rich countries, are public policy priorities, and do receive public funds, and of course, though the public sector can't do it alone, we need a strong role for the private sector, and public-private partnerships have been central to OPIC's work in supporting development, and increasingly I think they're being recognized as really important to reduce poverty. And I'd like to hear from you, Lauren, some of OPIC's experience in putting public-private partnerships to work to better meet the needs of SMEs finance.
Great, thanks, Alexia. So if there are 3 themes that you take away from my comments today, first one is that microfinance and impact investment more broadly is a perfect fit for OPIC's mission. The second is that OPIC really has been at the forefront of developing public-private partnerships, and in particular, we're very focused on the alignment of capital and bringing that capital into the micro and the impact investment space. And the third is that OPIC very much wants to support a client-centric approach to microfinance. And I'm going to use those 3 themes to answer your question, and by way of example, I'm going to talk about why OPIC was very excited to invest in the MicroBuild project, and why OPIC has invested in 4 of Global Partnerships projects. So, starting first with Patrick, with MicroBuild. MicroBuild really was a perfect fit for OPIC's mission. We had a great group of players in that transaction, starting, of course, with Habitat for Humanity and their selection of a world-class fund manager, the technical assistance component, and in particular, some of the things that Patrick discussed about how MicroBuild, through Habitat for Humanity, helps institutions develop the right type of microfinance housing product, a product that really meets the cash flow needs of the client and meets the household needs of the client. So we thought that from a mission fit, it was a perfect project for us. Second, thinking about the alignment of capital in MicroBuild, there's a very deliberate approach in terms of bringing in the investors in that project. There's some patient capital that's investing in the equity. MicroBuild and through Habitat put together a very important element of first loss, additional first loss protection in terms of some guarantee support. And then, of course, the technical assistance capacity building, a great alignment of capital that enabled OPIC to go into the transaction. We're, of course, very focused on making sure that what we do has a great impact, but also making sure that what we do meets our credit underwriting standards. So we needed to have the first loss that got us comfortable going into the transaction. And finally, in terms of being client-centric, I think this is a great example. The type of products that these MFIs that MicroBuild are investing in, these are the products that clients really value. It's just central to their lives. And as a consequence, these MFIs are able to acquire and retain clients. They're also able to form a close relationship with the clients. And in so doing, they're able to detect when there's some stress. So one of the benefits, quite frankly, of a client-centric approach is there's an important element of risk management. The MFIs are able to manage client risk better. Those are the 3 themes as we looked at MicroBuild. Turning to global partnerships, so we've invested in 4 funds, as Rick has mentioned. In terms of the fit, one of the things we noticed immediately with global partnerships is that they take a very deliberate approach in terms of putting together the capital and the capacity building. And that's something that was important to us because, as Rick has outlined, we wanted to see that the benefits went beyond just access to finance. We wanted to see that these benefits were hitting all elements of the risks and vulnerabilities in people's lives. And quite frankly, if you lack access to finance, you're quite likely to also lack access to affordable housing and healthcare, education, clean water, energy, and so forth. So the combination of credit and capacity building was very appealing to us. In terms of the alignment of capital, Global Partnerships really has been an innovator in this area. They've been very careful about finding the right type of philanthropy and investors and putting that together with the right type of risk that they're willing to take. And in fact, as you look at their growth over time, they've been able to mobilize more and more capital because of the way they focus on the alignment of capital. That was something that was very important to us, and we felt that we could be helpful by being an anchor investor, and in combination with fellow DFIs, FMO and IDB, we're able to help mobilize additional private capital. It's a great story in terms of alignment of capital. And finally, in terms of being client-centric, one of the things that Global Partnerships does very well is they very carefully select which MFIs and cooperatives are going to be their clients. And you can believe that if these MFIs and cooperatives are not client-centric, they're probably not going to be a good fit for Global Partnerships. So we like the approach they're taking there. The healthcare fund and what they're doing, as Rip has described, that is so important in terms of meeting the needs of clients. And I would say that in terms of risk management, if you look at the very careful underwriting guidelines and standards that they have, and as Rick knows, we kicked the tires pretty hard in due diligence and came away with renewed confidence. We think that they're able to manage risks well. And one reason is because they're very client-centric. So 3 themes for today, 2 great partners. I hope that is helpful in answering your question, Alexia.
It's absolutely convincing across the 3 teams and the 2 partners, absolutely. Yet, dear Lauren, I think that what can be achieved with public-private partnerships, CLEAR and OPIC has, I think, again, been a leader in this. But it's difficult. Partnerships in general are difficult, then partnerships around 2 very different cultures. So please, share with us some of the warts that you must have faced and how you dealt with them.
Of course, the warts don't exist on this panel.
No, this panel accepted, yes.
But we are often approached by people who want to partner with OPIC, and sometimes the problem is they have a great idea, they're unable to mobilize capital. Now, OPIC can be helpful in mobilizing capital, but we need to know that the fund manager, the sponsor, has also been out there hitting the pavement hard, and that they've got the ability to bring something in, okay? So that's one of the problems we sometimes face is great idea, unable to translate that into investor interests. And we're, not just walking away from that. I mean, we give a lot of thought to, well, what are the reasons why? And one of the reasons is because it's very hard to find first loss capital. Getting back to alignment of capital, we've done a lot of thinking here internally about how could we help to stimulate the investors, the donors that are interested and capable of taking first loss risk. And if we could unlock some of that capital, we can put in some of our own and mobilize additional private sector capital. So one problem is inability of the sponsor or fund manager to raise capital. I think another challenge that we sometimes face is that people take on too much. Rick and I were talking about this yesterday. There are some clients that Global Partnerships looks at where they are all over the map, and you have to love them in terms of what they want to do with respect to mission. But if they don't focus, it gets to your point earlier, Alexia, about discipline. If they don't focus, they're really not going to be the right candidate. So we do have people that come in and they just want to do it all under one fund, and it's just not realistic. One aside, since I have Isabel sitting next to me, I just want to give a shout out to Isabel. So a group of OPIC folks last year went to Kenya on a trip to talk with 3 of our MFI clients. They're receiving capital through 3 different OPIC programs, one through our funds program, one through our structured finance program and a risk share that we do with Citibank, and one a deal that was originated in our small and medium enterprise finance department. We went to Kenya to look at the developmental impact and the financial performance of these MFIs. But a critical element of what we did was to look at the smart campaign and client protection principles. We wanted to understand what these institutions were doing because we're a smart campaign signatory, and we have put the principles into our underwriting and monitoring. Through Isabel's help, we were able to get great support in Kenya and to really learn about what's happening at the industry level, at the regulatory level, and at the institutional level. So while you're next to me, I just want to thank you because it's really enhanced OPIC's ability to be more impactful in the way we do business.
What a wonderful testimony. Thank you. Thank you, Lauren. So, my friends, questions. Again, name, organization, and questions to any of the panelists are now welcome.
Or I can squat or I can pull it up. Hi, I'm Brian Cox. I'm president of MFX, and we are a currency hedging facility set up to serve the microfinance community. And full disclosure, both Microbuild and Global Partnerships are our clients. But Lauren, I think you talked very eloquently about all the ways that OPIC looks at mitigating risk, besides just kind of the standard credit parameters. But you didn't mention currency risk. And so I'm interested in how OPIC is sort of seeing currency risk, in these kinds of transactions, but also kind of more broadly in its portfolio. And do you see currency risk going down to the borrowers of these clients as something that can flow back in the form of credit risk? And are you encouraging your clients to look at currency risk in maybe more seriously going forward than you have in the past?
Great. We'll take all the questions together just to. Okay. Who is next? You were. Thank you.
Brian Vosick with Fink International. Had a question probably mostly for Patrick. Just wondering if you could maybe comment on any developments in savings products that could be, say, structured in a 1 year, 2 year time frame to help a client achieve a housing construction goal.
Great. We have time for 2 more questions. You were all nodding so vigorously during, we have a repeater. Okay, if there's no one else, we'll take the repeater.
Just a quick question for Lauren. Jose Biao, FRB Realty Capital, regarding the mortgage securitization product with OPIC. I don't know if you deal with that and how you would, because Mimi mentioned, the lack of secondary market for mortgages, and I'm mainly focusing on sub-Saharan Africa. But if the volume, and if it's even existent at all, based on the conditions of capital markets right now, and if you're dealing with any of those kind of any kind of requests in terms of mortgage securitization products.
Great. Final chance. Going once, twice, 3 times, just on time. See, there's a mic right there in the front.
Carl Valenson from Bingham McCutcheon. Rick, you mentioned mobilizing entrepreneurs, private investors in these projects. Obviously, they're the habitats and Amidiars and these kinds of things. I'm curious what the strategies are for bringing in that kind of first loss capital into what you're doing.
Great. So what I'd like to do now, and this time we'll start with Lauren, is answer a question that was directed at you. And if you have a final tweet, you know what a tweet is. Very short message for this group. Include your tweet. And we'll just go down this way. And Lauren, you had 2 questions, currency risk and mortgage securitization.
Sure. So Brian, thank you for bringing up what really is an essential point. At the end of the day, if we are unwittingly loading currency exchange risk on clients, then we're not serving them well. And we really need to think through the value chain here. So you have fund managers who may be exposed to FX risks. One solution for them might be to push it onto the microfinance institution. not a great solution, those MFIs then might push the risk onto the micro clients, the people who are least likely to be able to mitigate this risk. So if you want to try to address those issues, then you need to look for a hedging program that can cover the risk. And I have to say, Brian and MFX Solutions have done an incredible job of taking their capabilities and helping fund managers investing in microfinance institutions to find a place where they can go to hedge FX risk. And certainly, Brian, when we look at the funds that come to us and we do our underwriting, we want to understand what's happening in terms of their FX risk hedging strategy. Are they having any exposure at all? If so, is that limited to an amount that we feel comfortable with? Can they get access to an FX risk for the loans they want to make to their clients? As you know, some markets are particularly challenging. Rick could probably talk about this as well. And it may be difficult all in, including the swap cost, to be able to provide a loan product that will still meet the cost of capital requirements for that MFI. But it's absolutely essential that MFX Solutions and other FX risk hedge providers are available to hedge these debt instruments that fund managers are making available to MFIs. About OPIC more broadly, we've been doing a lot of thinking internally about how we'd like to cover off FX risk, not just in the microfinance sector and in other sectors. I don't have anything today that I would announce, but we definitely want to stay in touch with you and others as we try to think creatively about how we can help our borrowers address this fundamental risk issue. To the gentleman who asked me the question about mortgage securitization, I personally have not worked on any of those transactions, but I have a colleague, Deborah Erb, who works in my department. Debbie, I don't know if you're in the audience today. If you're not, I would be very happy to introduce you to Deborah Erb. She really is an expert in this area. She leads our housing finance here at OPIC, and so happy to exchange cards with you and to put you in touch with Deborah Erb. Final point, I would say, you know, when OPIC looks at what we want to achieve over time, as said before in the panel, we do want to put ourselves out of business, but unfortunately, there are so many needs out there, and it's going to be a very long time before that happens. But as we look at those needs, we need to find the right partners that we can work with to help us address the challenges that people at the bottom of the pyramid face. We're a small agency, and so we need to leverage the resources of excellent fund managers. We need to drive private capital into the space. We need to work collaboratively to be able to understand what the client needs and to deliver the appropriate product and service in a way that's respectful and that protects them. That would be my closing remarks for today.
Excellent. I'm not sure you've mastered tweeting quite yet, but excellent. Thank you very much, Lauren. Isabel, your tweet for us.
Okay, I'll try to stick to the limit
40
of characters. One of the main roadblocks that was identified in the shelter report was the lack of financial options. And I think that one way to get at that is to work towards full financial inclusion. So my last words would be to invite you to participate in the Financial Inclusion 2020 movement. It is a movement, not a discipline. There's a lot of information available on the Center for Financial Inclusion website. And as was outlined before, it will require the collaboration between the private sector, the public sector, but also nonprofits. So clearly we need as much support as we can to get that. So that would be my final comments.
Thank you, Isabel. Rick, you had a question around mobilizing entrepreneurs, and then your tweet, please.
Okay. It was around impact capital. That's the focus of the question.
Yes, sir. Yes.
So here's how we're thinking about it. We've tried to have a pretty nuanced view of what the capital segments are and not only how we can access it, but what role they can play and how those segments are going to evolve. So we think about philanthropy in a certain way, that it's catalytic. And the pitch that seems to be working there is not only when you're clear and compelling about what the impact is going to be at the household level, but when you can point to a huge amount of resource leverage. So if you can get 8, 10 to 1 resource leverage combined with a compelling impact story, that seems to be a pretty effective strategy. I'll walk you up a fund structure. So the next one for us would be essentially PRI capital, where they actually want it back with low cost. Their combination of social return and risk-adjusted financial return is different than normal investors, and that presents an opportunity not to actually do first loss or to drive venture philanthropy, but to take a risk position you can't get done through the development financial institutions or through other types of less experienced impact investors. The DIFIs have played a catalytic role for us at the MES level. That discussion, our experience is that all development financial institutions are not created equal. There are some that are actually just as commercial in their orientation as venture capitalists and private equity folks, and there are some that are holding the combination of risk-adjusted returns and genuine development and social impact in a holistic way. One of the reasons we work with OPIC and the other partners that we have is that they hold that way, and that allows us to collaborate in terms of the holistic approach we're trying to take. And then I see an emerging market of high net worth individuals, family foundations, wealth advised individuals that is nascent and rapidly coming on as people want to reflect their values, not just in their work, but in their investing and in their consuming. And so we're positioning ourselves not just from a product design point of view, but from a channel management point of view, to kind of be substantively engaged with those folks. And what I typically find is that they will start with their fixed income portfolio, because equity is the hardest thing. And as they have a positive experience of actually getting capital back with some kind of financial return and a clear social impact story, they move over time, and they either move into other asset classes or they move in terms of readjusting their PRI and their philanthropic activity. So I see a big opportunity there. Yeah. So I hope that's helpful.
Tweet. Really tweet.
Tweet. If we want to achieve our global development objectives, we're going to have to make markets really work for people living in poverty, and you can't be disconnected from the household.
Excellent. Thank you.
That's under 140 characters, just for the record.
Poster child on tweet. Poster child. Experience. No pressure. No pressure, Patrick.
I'm going to take his extra characters.
And before you take his extra characters, a question on savings.
Sure. So savings is obviously got a very deep link with housing, interestingly, because not only do you save to build a home, but a home can actually serve as your savings, right? So it's kind of got this dual purpose. So we obviously find that to be critically important. Another interesting phenomenon I would point out is kind of this in-kind savings mechanism that we have witnessed a lot and seen in a lot of our programs. We see people essentially kind of saving up a little pile of bricks somewhere, right? So rather than necessarily kind of having it be cash savings, people, and again, with prices of building materials having historically, over the short term having gone up increasingly, people are buying those and kind of stowing them away so that they can use them to match with maybe some credit to go ahead and do a second intervention on their home, or a third. So that said, we are trying some experiments. Right now in Asia, we are kind of looking for whether an incentive structure for savings for a specified product, like to do a home improvement, whether that encourages very poor people to save more. So it's a program where we're actually subsidizing the incentive match, but trying to see kind of where those triggers are, to get people to kind of put down more money and to save more money than they have been historically. But we are, as we're also doing product development with institutions, for example with Microbuild, we are strongly encouraging, in addition to that in-kind savings, a 20% savings match to be put in right at the time that the loan gets triggered as well. So that's just kind of using conventional wisdom right now. We haven't got a lot of learnings yet. We're pretty early as to whether that's the right percentage, and I think that'll vary by context too. But so good question. And then my tweet, I'm going to tie it back to the advocacy report, because as we are trying to build better markets, more responsive markets to low-income housing, we see that sort of that third piece being advocacy. There's impact capital, there's building capacity in the market, and then there's making sure that there's an enabling environment that allows that market to thrive and allows households to benefit from the growth of that market. So, for example, we would take that advocacy report nationalize that, which is part of the plan to kind of contextualize it and have it be used locally. So that might be used to change building codes so that exposed rebar in the city is okay, because that's what happens when you build incrementally, right? That's prohibited in many cities. Or so that government subsidies be redirected to plan for incrementalism, the way people are building. So there's numerous things that can be done on the advocacy front to really get markets to be more effective for the poor.
Great, thank you so much, Patrick. Dear panelists, it's really been an honor to be here with you, and also I've learned from you, but also from the questions that were raised, and just want to leave everybody with 4 quick takeaways from my side. The first one is music to my ear to hear: clients first. We need to be relevant to clients' lives. We need to respond to the risks and the vulnerabilities they face. We need to offer not just access, but quality. Clients first. Second point, capital. Not all capital is the same, so in understanding the role of different types of capital at the right time and valuing all kinds of capital. The fact that it's so difficult to find first loss capital, I think I hear some people saying, well, I don't want to be first loss. It's sort of not, some people can't, but I don't want to be. And I think we need to value the importance of the first loss capital as well. Third point, everybody said capital, yes, but capacity, technical assistance also. And the final point, which was not said as strongly, but I think I heard Rick mention, is to make the economics work of some of what we're trying to do. Scale, 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 and of course, scale is also linked to impact. Thank you so much for your attention. Thank you so much, panelists. Please join me in saying thank you.